Divya ma'am, balance sheet plays such an important role in all businesses. I wish to know more about it.
Sure, Anil. Balance sheet as well as P&L statement plays an important role in all sort of business. Let me tell you more about both of them in greater details. The balance sheet represents the financial position of a business as of a particular date, typically at the end of a quarter or financial year. It is divided into two parts: assets and liabilities. Assets or use of capital includes all goods and property owned by the business, as well as amounts due to the business. The liabilities include liabilities and shareholders' equity, or the source of capital. This itself includes all amounts and debts owed by the business and the shareholders' ownership interest in the business. You should at the same time remember that total assets is equal to total liabilities plus shareholders' equity. Do you know that both assets and liabilities are classified into two categories, Anil?
No, ma'am. What are they?
Both assets and liabilities are classified as current and non-current. Current refers to those items that are due in the upcoming financial year. That is, they are due within the next 1 year. Non-current refers to those items that are due after 1 year. You could think of current as short-term and non-current as long-term. Assets are classified as current and non-current assets. Current assets are those assets that are expected to be sold or converted to cash or consumed within 1 year. Non-current assets include plant, property and equipment, PPE, which typically last for more than 1 year. Let's discuss more about the different types of current assets. The common types of current assets are cash, inventories, receivables, and short-term loans and advances. Now, let's look at each of them. Cash is the amount held in bank accounts by the business at the end of the financial period. Inventories is the value of raw materials held, work in process, and finished good held by the business. Receivables are the amounts due to the business from its clients or customers to whom goods or services have already been provided. These are typically sales made on credit. Short-term loans and advances are loans and advances given to other entities like suppliers, which are due within 1 year.
Earlier, we have discussed about a petty businessman called Raju the Thelawala. Can we apply the different types of current assets in his case, ma'am?
Sure, Anil. Let's check how all these are applicable in his case. Going back to Raju the Thelawala, remember that he sold the vegetables for rupees 3,000. Last time, we assumed that he sold his entire stock of vegetables and he received cash of rupees 3,000 from his customers. This time, let's make some changes in his business dealings. Now, suppose he was able to sell only rupees 1,500 worth of vegetables out of the rupees 2,000 worth of vegetables he bought. Also, he has an informal agreement with some of his customers who pay him only once every fortnight. In other words, he offers credit to valuable customers. He sold the vegetables for a total of rupees 2,250, for which he received rupees 1,500 in cash, and the balance rupees 750 will be paid after 2 weeks. Remember, Raju's balance sheet looked like as shown on the screen after he bought his thela. He also receives rupees 1,500 in cash from some of his customers when he sold vegetables to them. So, his cash balance is now 10,000 minus 2,000 plus 1,500, which is equal to rupees 9,500. He has not sold rupees 500 of his vegetables, which will now show up as inventory on the asset side. It is specifically a current asset. He also has not received rupees 750 from some customers. This amount will now be entered as receivables on the asset side. It is again specifically a current asset. Here is the table of Raju's updated assets. You can see that his assets starts with the amount he paid for the thela, which is rupees 10,000. Then, as current assets, he has cash worth rupees 9,500. In his inventory, there is an amount of 500 rupees, while as receivable from some of his customers, he has an amount of rupees 750 only. So, his total current assets is 10,750 only. With the worth of the thela, his total asset is now 20,750.
That was easy to understand. Now how about the non-current assets? Are there also various types of non-current assets, ma'am?
Yes, Anil, there is. Let me tell you about the common types of non-current assets. Common types of non-current assets are tangible assets, intangible assets, non-current investments, and long-term loans and advances. Tangible assets includes fixed assets like machinery, building, or land. These are commonly referred to as plant, property, and equipment, or shortly PPE. Intangible assets includes patents, trademarks, copyrights, goodwill, brand, or recognition. These are not common for small businesses and startups. Non-current investments are investments that mature in more than 1 year. Long-term loans and advances are loans and advances given to other entities like suppliers which are due after 1 year. Now, let's apply the non-current assets in the case of Raju the Thelawala.
Yes, I would like to know how it works.
Raju spent rupees 10,000 to buy his thela. This is his business's fixed asset. He does not have any other non-current asset. This is the table of Raju's updated assets as we have discussed earlier. His non-current assets is the same as his current assets. After assets come liabilities.
Are liabilities also classified differently, ma'am?
Yes, Anil. Let me tell you more about liabilities. Like assets, liabilities are also classified as current and non-current liabilities. Current liabilities are liabilities that become due within 1 year. Non-current liabilities are liabilities that are due after 1 year. Common types of current liabilities are payables, short-term debt, and current portion of long-term loans. Payables are expenses that have been incurred but not been paid as yet, but need to be paid within 1 year. Short-term debt are any loan that is due within the next 1 year. Current portion of long-term loans are part of long-term loans that are due in the next 1 year. Non-current liabilities mainly include any form of borrowing or debt or loan that is due to be repaid after 1 year.
Ma'am, you also mentioned something about shareholders' equity. How does it work?
Yes, there is this factor called shareholders' equity. Let's know more about this factor. Shareholders' equity represents the total equity interest of all shareholders in a business. It represents the net worth of the company, which is the difference between the business's assets and liabilities. Shareholders' equity consists of two parts: share capital and surplus. Share capitals are funds raised by issuing shares in return for cash. This represents how much capital the owners have provided to the business. Surplus is a business's profit, which comes from the profit and loss statement.
Can we apply equity in the case of Raju the Thelawala, ma'am?
Definitely, Anil. If you look back at Raju the Thelawala, you will remember that he paid rupees 2,000 in cash to buy vegetables. This time, let's make some changes in his business dealings again. Suppose he paid rupees 1,250 in cash to buy vegetables, and he bought the balance rupees 750 worth of vegetables on credit. He will pay his vegetable supplier the rupees 750 after 2 weeks. After buying the thela, he had rupees 10,000 in cash. He spent rupees 1,250 to buy vegetables. He received rupees 1,500 in cash from some customers. His new cash balance is now 10,000 minus 1,250 plus 1,500, which is equal to rupees 10,250. Raju owes rupees 750 to his vegetable supplier, which means payable is rupees 750 under current liabilities. He was able to sell rupees 1,500 worth of vegetables for a total of rupees 2,250. His profit, which will get added to the surplus under equity, is 2,250 minus 1,500, which is equal to rupees 750. He has not borrowed any money, and so his non-current liabilities are zero. This is Raju's updated balance sheet. Let's look at the net worth of Raju's business. The net worth is equal to total assets minus total liabilities. In Raju's case, it will be 21,500 minus 750, which is equal to rupees 20,750. At the start of the business, the net worth of Raju was 20,000 minus 0, which is equal to rupees 20,000. So Raju has added a net worth of rupees 750 from operating his thela, which is the profit from his business. P&L stands for profit and loss statement. It is also called income statement. It shows the business's operating results for the period, which could be a quarter of a year or a whole year. The net income after profit and loss is equal to revenue minus expenses. Any income or profit not paid out to shareholders is called retained earnings. Retained earnings are accumulated over time on the balance sheet under surplus on the shareholders' equity part of the balance sheet. For Raju, the surplus was rupees 750.
Ma'am, you also said about the factor called inventory. How does it function on the business front?
Yes, let me tell you about the functions of the inventory and what is it. Inventory is the goods held for sale or items used in the manufacture of products that will be sold. Cost of inventory held is reported under inventory on the balance sheet. Once the inventory is sold, it is reported as cost of goods sold. It is shortly called COGS on the P&L statement. The calculation of the inventory is made by this simple formula: beginning of period inventory plus purchases, which is equal to COGS plus end of period inventory. In the case of Raju, he started with zero inventory. Bought inventory worth rupees 2,000. sold rupees 1500. So, end of period inventory is equal to 0 plus 2000 minus 1500, which is equal to 500. This amount of rupees 500 is entered under inventory in the balance sheet. Now, let's look at what expensing, capitalizing, and amortization is and how they affect business. In the case of Raju, you can see that the cost of the thela, which is rupees 10,000, it only appears on the balance sheet. It does not appear on the P&L statement. It does not affect the profitability of Raju's business. This is expensing. Now, why does this happen? It is because assets and expenses are two sides of the same coin. If the benefits of a cost are expected to accrue in the same period in which the cost is incurred, then the cost is expensed in that period. In other words, the entire amounts appears as an expense on the P&L statement for that period. Capitalizing means the entire amount of the cost is shown as an asset in the balance sheet. If the benefits of a cost are expected to accrue in the future periods to when the cost is incurred, then the cost is capitalized in that period. Example of capitalized expenditures: property, plant and equipment, or shortly called PP&E. Capitalized costs are eventually charged as expenses to the P&L statement. Amortization is the process of allocating an asset's value to those future periods when its benefits are expected to be earned, typically over the asset's useful life. For example, if an asset's useful life is 5 years, then 1/5 of the asset's value will be charged as an expense during each of those 5 years in the P&L statement. Most common example of amortization is depreciation, which is the terminology used for amortizing PP&E. The cost of Raju's thela will be depreciated over its useful life. If we assume that its useful life is 10 years, then rupees 10,000 divided by 10 is equal to rupees 1,000 will be the annual depreciation expense on the P&L statement for each of the next 10 years. At the end of the financial year, the rupees 1,000 will be deducted from Raju's profit before taxes are computed. SG&A expenses include sales agents' salaries and commissions, advertising and promotion, travel and entertainment, executives' salaries, office payroll, and office expenses. This usually includes depreciation expenses. Here is how a P&L statement looks. The different profit measures are shown in bold after each expense is deducted.
Thank you, Divya ma'am. Now I know so much about balance sheets and profit and loss statements.
You are most welcome, Anil.